Good stuff. So next panel here, pretty excited about this one. It's going to be all about European stablecoins. Panel discussion, and we have a few very interesting speakers. From your left to the right, we'll have Paolo Di Stefano, Director at Collateral Management, Frankencoin Association. Make your way to the stage. Rupertus Rothenhaeuser, Chief Commercial Officer, AllUnity. Daniele Tedoldi, Head of GTM and Sales at Dakota. Derick David, Founder in Residence, Vento and X-Rain. And then lastly, one of our past co-founder of ETHMilan, Alessandro Raboni. Welcome everyone.
Right. Very excited about this one. Just want to give like some quick context, then we'll go around and everyone is going to introduce themselves. So, I mean, even 1 year ago, I would say like it wasn't really a thing. Now it's growing. Like quick data, like still 98 to 99% of the stablecoin market is USD denominated. But this year we've seen like some decent growth. We're approaching $1 billion, which is still very, very irrelevant, I would say. But we are going in the right direction. We have like, just like, it's fresh news, Kivalis, for those of you that don't know, it's just doubled in size. It was like 15 banks a couple of weeks ago. Now it's 37 banks. And they also have like some international player like ABN AMRO backing them. And so there is a lot going on, and it's getting very political. And I want to deep dive. But first of all, let's go around and introduce yourself. From Paolo.
Yes, hello, good morning everyone. To the ones who attended our side event yesterday, I hope you got some nice rest after the aperitivo. So my name is Paolo. I'm Italian, but I grew up in Switzerland, and I'm here to represent the largest Swiss franc stablecoin, which is Frankencoin. So I'm part of the Frankencoin Association. The Frankencoin itself is a fully decentralized, over-collateralized, and Oracle-free borrowing protocol on Ethereum. So that means the Frankencoin Association that I'm a part of is not the issuer, but a non-profit steward supporting the protocol's development. And my particular role at Frankencoin is to expand the collateral base. So by adding more collateral assets for people to mint Frankencoin, this drives more utility. People can use a wider variety of assets, and it also diversifies the risk in the collateral base. So very excited for the panel today.
Yes, thank you. My name is Rupertus. I'm with AllUnity since day one. AllUnity was created, founded in February 24 in Frankfurt. We have a EMI license under German BaFin regulator, being BICA compliant. And I have to correct or be a bit more precise to Paolo. They are decentralized, we are centralized. Our business is regulated MiCA compliant stablecoins, and I'm happy to answer questions from the side of things regarding US dollars and what do we do different from the rest of the world. We have just launched a stablecoin in Swiss franc as well. We have a Euro stablecoin. We bring a Swedish krona stablecoin on June 15th. So we have a complete, let's say, roadmap to add additional stablecoins, because we are a strong believer in the idea of every FX will be on chain eventually. Thank you.
Hey guys, nice to meet you. My name is Daniele Tedoldi. I head up all of sales go-to-market for Dakota. Dakota is a US-based stablecoin orchestration platform. Our goal is to help move money at the speed of the internet via stablecoins. And so quite practically, our product is an API that you ingest into your fintech to essentially issue virtual accounts, virtual wallets to your end users and allow them to on and off ramp. So.
Hi everyone, my name is Derick David. I'm currently a founder in residence at a venture building program by XR Ventures in Turin. It's called Vento. We're currently working in the intersection of AI and stablecoins. Before I was working at this stablecoin company called Rain, which is a startup that's now valued at $2 billion. They basically started as like the Brex for crypto. Now they're becoming like the Stripe for stablecoins.
Great, thank you guys. So we have like in this panel like obviously from entrepreneurs like Rupertus and Paolo from a different angle. Like you guys are more of an association, and then we have like obviously experts that are like scaling things globally and having like more overarching like view on the market, like you guys from Dakota and Vento. So all the question and X-Rain. So all the questions gonna be like you can grab it or you can pass. It doesn't matter. Like so first question is more obviously for Rupertus and Paolo. So it looks like it's a little bit of a mess, like always in Europe, right? We have like digital euro, we have like stable coins, we have Lagarde that is against, we have like now this Kivalis, which we have Bancomat. Like it's getting very crowded, but the market cap is still embarrassingly low. So, in my opinion, so how can we scale European stablecoins? And what are some of the use cases you're seeing now that you guys are pioneers? Like now, like you did it before all of them. So what are the challenges and how do you see the next wave of growth? How do we fix it?
So I think for Swiss franc stablecoin, it's very easy to answer that one. So what a Swiss franc stablecoin can, that a USD stablecoin can't, is to preserve your purchasing power over time. So if you look at the history of the US dollars, over the last 50 years, it has lost about 70% of its purchasing power compared to Swiss franc. So I think there should be alternatives to such a weak currency on chain. And I think also the spirit of crypto is that we want to get away from the traditional financial system for which the US dollar is basically the pinnacle. It stands for overspending. They're using Tether and Circle's USD stablecoins as a vehicle to even fund more of that overspending. So I think we really need to step up and give people alternatives on chain.
How much time do I have? This is, you ask like the mother of all questions, and I want to start with the very simple answer. I will be very excited to find out what Kivalis does and what it doesn't, because so far they have nothing. They have just a company and they're adding banks. They have no license, they have no regulation, they have no product, they have no tech, they have just very little. So I'm pretty relaxed that we have a good year in lead time before Kivalis pops up, and then I still don't understand what their business model is. Our business model is very simple, and I can explain in 2 sentences. We couldn't care less if a retail individual is buying his Bitcoin with stable coins or with fiat. Doesn't make a difference. It's not a use case. It used to be a use case in the past when Tether and USDC were sort of alone in the world. That's the first thing. The second thing is our main objective is building global payment rails using stablecoins, and we are the product that is transferred from A to B. There's somebody who converts fiat into stables, there's somebody who moves the stables from A to B, and there's somebody who off-ramps the stables in the destination address. And we are just the tool in the middle. And I couldn't care less, once again, if it's a digital euro that is being transferred or a digital yen or a digital Aussie dollar. What I do know is if our institutional clients such as Daimler, Siemens, Deutsche Telekom, if they send digital euros to Australia, the receiver doesn't need digital euros, at least not now. Maybe in 10 years there is enough stables in circulation, but right now there is probably very likely that he will off-ramp instantly into Aussie dollar fiat. And this is what we're building. So it's all about payment rails, adding additional digital currencies into the game. And why did we originally do it? You're absolutely right. Right now, US dollar stable coins represent 99.9% period of the transaction or TVL volume. Yeah, but in the real fiat world these days, the dollar percentage is roughly 60%, and 20% is in euros. So if we simply do the analogy, if we move currency on-chain, and Tether and Circle were just smart enough 10 years ago to do it, and now we have to catch up what they've been building in the past. But if this 20% fiat SWIFT payment is somehow moved on-chain, there's a tremendous amount of money to be made.
Absolutely, and you don't have to convince me. Like, I'm a supporter. For you guys from the industry, are you seeing like growing demand? What's your experience for you, Derick? Later, maybe even first. For you later, like, what are some of the best design practices? But first, Daniele on the...
Yeah. Look, I don't think you can replace the dominance of US dollar stablecoins. However, I think there are very specific use cases for Euro stablecoins. And so if you think about a European business who has revenue in euros, costs in euros, payroll in euros, it doesn't really make sense for them to use dollar stablecoins because they're being exposed to FX risk. And so I think for these specific use cases, Euro stablecoins make a lot of sense. And we're seeing a lot of demand for them, but I think it's for very specific use cases. So yeah.
Derick, from so you're one of the founders of Rain, founding team. I'm curious, like, what are some of the best practices in terms of design, and how did you design the product, and what could be beneficial for Euros?
This is a very good question, actually. I remember in the early days of Rain, we were one of the priorities that we had is to make the end users feel like they're not using a crypto product at all. So we're trying to make applying abstraction practices in terms of design and making sure it's frictionless, smooth. But at the end of the day, what we learn and that Rain is still doing now is that they made the design invisible, so the end users don't feel like they're interacting with the crypto or stable coins at all. So and I remember back in the days we learned a lot from Mercury and Ramp because we like their design, and it's one of the best UX. So we took a lot of inspiration from them. Then we applied it to Rain.
Awesome. I want to add like a few more notes for the audience. So you could ask like, why do you need like European or Swiss franc stablecoins? But let's focus on Europe, because you could think, okay, digital euro is coming. But digital euro is not going to be programmable. And they already said that, right? So there is the space for European stablecoins, which will be the only form of programmable money. So it's just a matter of, I think we'll see a variety, like more issues like AllUnity, but digital euro, again, I repeat, is not going to be programmable. There is going to be an online version, an offline version, which I'm really happy about for different reasons. But there is not going to be any API. It's just going to sit in your bank. It's going to come probably in 2029, 2030. But the rest of forms of money, if you want to do some different flow, if you want to move money around, it's not going to be done with digital euro. So that's why, again, we are talking about this. It's a big topic, but most people, I don't know it because the information is not very accessible, I would say, to this day. So we have like two different approaches here. So one is a decentralized approach. The other approach is regulated, MiCA compliant, etc. So sell me your vision for that first.
Yeah, so I think the regulated versus decentralized approach is particularly interesting for the Swiss franc stablecoin because famously Swiss franc interest rates are negative. So as a centralized issuer, if you have to back your stablecoin with cash or cash equivalents, it's going to be very difficult to scale that. So with the Swiss franc, we see that the decentralized approach is actually much easier to scale. So basically the way Frankencoin is backed is instead of being slightly over-collateralized with cash and cash equivalents, it's heavily over-collateralized with other crypto assets. And the people who are minting Frankencoin, they are actually borrowing on-chain. So they're also open to paying an interest to borrow Frankencoin. And that interest can then be passed on to the holders as a yield. So how this works is that 100% of the Frankencoin that are being minted, they're paying 1 or 2% of interest for these Frankencoins to exist. And then about 30% of the holders of Frankencoin are staking or saving those Frankencoins in the savings module, and the yield can be passed on. So I think one of the big differences is the yield aspect when it comes to Swiss francs, but happy to hear the benefits of AllUnity as well.
I couldn't agree more, and we have entered into a partnership with Frankencoin because we bridge, so to say, the easy exit path for Swiss franc holders into Frankencoin. So you can mint AllUnity stablecoins and then you can swap it on the Frankencoin platform because I'm not allowed to pay interest rates. Nevertheless, there is no interest rates to be shared in Switzerland anyway. But sharing nothing is still nothing. But even in other countries where we have positive yield curves for the collateral management, I'm not allowed to share any revenue for MiCA regulatory reasons. So this example in Switzerland where we work together is a fantastic blueprint how centralized regulated stablecoins can drive adoption in the decentralized space because they can create yield, as Paolo just said. We cannot create yield. So we are quite happy about this partnership. Yeah. And on the other side, Alessandro, to answer your question on the Euro stablecoins, it is a challenge, and we are not alone, and we will for sure not be alone. And I share absolutely your idea of there will be many different ways of digital money. There will be CBDCs, there will be tokenized deposits, there will be digital monies from the central banks, there will be stable coins, but every customer, client, prospect has a certain specific use case and an idea why he needs this particular version of money. If I want to pay an invoice when a container ship enters the harbor in Tokyo, you can program the money and somebody breaks the lock and the transfer is instantly done on chain. That doesn't work with any other company, any other form of digital money, because most of the other digital money formats are most likely on permission chains, not programmable for an internal network. Of course, if JP Morgan Onyx is a fantastic example how an internal stablecoin, and they have it since 10 years, 6 years, 8 years. It works perfectly, but they cannot use it to send money from JP Morgan to Mitsubishi Bank in Japan. That doesn't work here. So it is always the question of the initiator, what problem do I want to solve?
Yeah, that's great. Maybe can you explain, or anyone else that wants, the difference between a stablecoin and a tokenized deposit for the audience? Because today it's very talked about, but I think it will be beneficial.
In a stablecoin needs a regulated framework. It needs a minimum of an EMI license. So AllUnity is a limited company, limited by liability. We have applied with a base prospectus and a license application to BaFin, and the license we received is simply the issuance of stablecoins, which means first buyer comes in, needs to be onboarded, sends me money, the machine room recognizes there's money coming in from an investor, transfers the fiat money into digital money, sends the digital coins to the first buyer, and moves the funds into what we call the reserve bank and allocates it into money market funds, cash or cash-like stuff. That's how a stablecoin is operating. A tokenized deposit is always a bank internal product where you simply tokenize an account. So out of a classic bank account, you create a digital bank account. And this is then transferable as if it would be a stablecoin on chain. You simply enable an account or a wallet holder of a tokenized deposit to send fractions of his deposit money on chain from A to B, but only within that bank. And the difference is, so it acts like a stablecoin, it smells like a stablecoin, but it is not a stablecoin because on tokenized deposits, the bank can pay you interest rates. You still keep your money with the bank, so you receive interest rates, which is different to stablecoins. As I said, you cannot collect interest rates with stablecoins. So a tokenized deposit is a digital format of a cash account that enables the transfer of money on-chain within a certain closed loop, most likely being a bank. So you cannot, as I described, you cannot transfer a tokenized deposit from Commerzbank Frankfurt to Standard Chartered Singapore. It doesn't work because they use probably different protocols, different parameters, different interest rates, different FX rates. So it's just not work. It's not programmable. It's a proprietary bank-alone solution to enable on-chain transfers and still pay interest rates.
So we have to go backwards to then go forward. Anyways, I'm curious, Daniele and Derick, what do you think of this product, tokenized deposits? And also, how do you work with decentralized and also regulated stablecoins, maybe at Dakota and for you in general?
Yeah, I can touch on, we work with fintechs, neobanks, payment service providers, remittances, and these companies all have compliance teams. And so they want to touch regulated stablecoins. And so we see a big demand for those from our customers. But there's obvious use cases for the others as well. But that's what we're seeing at Dakota. It's a big ask for regulated stablecoins.
And Derick, what's your view on these new products from banks, tokenized deposits? If you want to share, do you think it makes, from a design perspective, does it make sense? Which kind of use cases I think they unlock and which they don't?
I mean, they definitely have potential. I mean, you have to think of how what's more the reward here than the risk, right? So whenever I see tokenized deposits, you can call them. Some people they don't call them like that, but to me, if it gives the end user more benefit than reward, then that's more important to me at the end of the day.
Perfect. I want to touch upon more the geopolitical side a little bit. So obviously the fact that we have the biggest stablecoin in Europe is issued by Circle. So I think that's a big elephant in the room. And obviously I think that all of these European initiatives, including Digital Euro, were done in the first place to get away from Visa and MasterCard that again are American issuers. And yet Circle managed to be the biggest one so far. But how do you see this evolving? I don't think it's gonna end up well, I think. And that's why Kivalis is there in the first place. But and probably also AllUnity, etc. So if whoever wants to grab it.
You hit the nail on the head, Alessandro. A lot of large corporates we talk to simply do not want to engage with the US issuer of stablecoins. And I believe that EuroC could have reached X-Falls of TVL if they would not be Americans. Don't misunderstand me. We love Circle. We are part of the Circle payment network. So they accepted AllUnity stablecoins on the payment network. So we work with them quite closely. And but we hear it all the time, specifically since the Trump administration took over reign in the US. Corporate captains get a little bit concerned if somebody presses the red buzzer and payment rails are suddenly disrupted. And for this reason, people tend to wait or integrate or build a European solution. Which one at the end of the day will succeed or will be superior to the others, I don't know. We pitch for the business as well. But the geopolitical aspect is definitely important. But it's not only important compared to the US. I mean, even in Europe, there's a big competition between, does Germany have their own stablecoin? Yeah, we have one. Does the French one have one? Yeah, okay, they have one as well. Do the Spanish have one? Yeah, they have one as well. Do the Italian have their own stablecoin as well? Well, not yet, but maybe soon as well. So every local regional government is interested in showing, yeah, I'm part of this digital transformation as well. And that's why MiCA was more or less implemented, and it took 7 years, but at least it's, and we can have a lot of critics about the MiCA rulebook, but at least it's something that 27 member states agreed on. Yeah, at least they found some common understanding of how the digital product of a stablecoin can be handled. So, but the geopolitical aspect is monster, and I'm traveling excessively these days. I was in Taiwan 2 weeks ago, I was in Ghana last week, and everybody is in the process of creating their own stablecoin regime. And they look into MiCA as a blueprint, they look into the Genius Act as a blueprint, they look into Hong Kong, they just launched their stablecoin regime. So everybody's gonna come. Yeah, and everybody wants to make sure that they're not missing out in the big game of digital payments globally in the future.
Thank you, great answer. Anyone else wants to add something else, or we move on? Okay. So I totally agree, and I think I'm curious, obviously, about the future and which kind of private money, like, do you think we will see? Like, Rupertus, you touched like upon a very good point. Like, you know, even in Europe, where we have euro, we'll probably see some form of competition. Even like, I mean, MiCA has done a great job to avoid also that. But otherwise you could have seen, like, I don't know, a form of euro only backed by Italian bonds, and then like, or French euro backed by French bond. I don't think it's possible under MiCA, if I'm not wrong. But if not, they've done, in my opinion, a great job, the regulators, to avoid that. But for example, in the US, right, where the landscape is completely different, obviously it is more like a laissez-faire kind of approach, like we expect. So, which kind of private money we will see? Like, for example, in the US, like, how is the stablecoin landscape emerging? Maybe for you, Daniele, that you talk a lot with the industry.
Sorry, what do you mean by how's that?
Like which kind of project we will see? Like big companies issuing their own stablecoin. How do you see that evolving? Like beyond maybe, you know, Circle and because what Rupertus said, like we're gonna see like a very crowded space, right? So which kind of projects do you think we will see?
I think on a larger scale, what we're seeing and where we think this is going, especially in the US, is like any marketplace will really want to become a bank via stablecoins, some form of neobank, because if you're touching a lot of money and moving money from counterparty A to counterparty B, think about Uber, right? The cost that they have to move money around and pay all their drivers and take money in from the people that are actually paying for the rides. If Uber had its own stablecoin, they could earn yield on that and simultaneously move money around much faster. And also drivers could potentially choose to hold their balance in the Uber stablecoin, earn yield on it, and then deposit it to their bank account whenever they want to. So we're seeing a lot of this, and we think that this is like kind of where the industry is going in the United States. And so obviously like US dollar backed stablecoins for that are a great solution. And so we are actually launching our own issuance in the coming quarter, and so we hope to take a piece of that pie.
Perfect. I mean, I studied economics, right? And when I look at Michael Porter, right, and I applied his theory to stablecoins, then I'm like, okay, it makes a lot of sense, right? If I have a power over my suppliers and I can impose my currency, then it's gonna go a long way. So, and Derick, for you, how do you see that? Like, I'm talking about, Michael Porter is an economist. Basically, I don't know if you're familiar with it or if you remember it. How do you think, seeing like stablecoin being used to impose power over suppliers, right? Because that's, I think, what's gonna happen. From a design perspective or like any perspective you want, do you think that's an interesting use case?
I would say definitely yes. From supplier perspective, there's definitely this data that supports this trend that we're seeing since like 2024. And as a matter of fact, I've seen new stablecoin startups that are working on this type of idea. So, and supporting also to what Daniele said, we're seeing a lot of platforms just doing something in stablecoins, right? We saw Deal, which is this payroll platform, launching a stablecoin feature to allow employees to get paid with stablecoins. So everyone is just doing stablecoins nowadays, and as like you said, nobody wants to get left out. But also from a company perspective, there's the money aspect, right? Because they can be more optimized, they could be more efficient.
Daniele, you wanted to add something? Okay. Then I think it's gonna be a wrap soon. So just gonna go around, like, if we talk in 1 year, how do you see this space evolving? In particular, looking at Europe, but not only that. Like in 1 year, what would have changed for stablecoin if we come back here? From Paolo to Derick.
I hope that in 1 year from now, we won't be comparing local stablecoins with USD stablecoins, but local stablecoins with local fiat rails.
The secret of success and adoption in the near and midterm future depends on the willingness from banks to open their gates and put their shoes from the brakes. That's the short answer. Because when we speak to corporate customers and they understand the use case and they have a problem that they want to solve, the first question is, who does the coin conversion for me? And then I say, well, it's your bank. And then the answer is, my bank doesn't offer me coin conversion. And then what else do I need to do stablecoins? And then you need a wallet. Where do I get a wallet from? Well, go to your bank. They should be able to provide you a wallet. Guess what? The bank doesn't want to offer them any wallets. And then it means the corporate has the option, either he gives up a 50-year-old banking relationship, which is unlikely to do because he has got other business to do with the bank, not only stablecoins. And on the other side, he's not so hot in starting self-custodized wallets and MetaMask and Ledger Nano in the pocket in order to enable stablecoin transfers. So that is the crucial point when mass adoption will take place, is when the TradeFi sector opens up and the pressure is mounting every day. And I guess, from answer your question, in a year from now, I would not be surprised if the total outstanding TVL in stablecoins have doubled once again, because it is happening. And Daniele made an example, and the Uber type of guys, they don't give a shit. They just do it. They don't ask their bank. They just do it. Yeah, and there's a bit of a difference. And if you speak to Revolut or Robinhood or Bitpanda or Trade Republic in Berlin, these young neo brokers, you open a bank account and you instantly get a wallet attached to it. You don't even need to ask for one. You get one open without you knowing about it. So it's happening. It's just a question when the TradeFi sector will be mature enough to say, okay, let's open the gates, because they're going to lose business anyway.
Also, when Mark Zuckerberg is coming back, right? We're all waiting for that.
Yeah, I think inevitably stablecoin adoption will double over the next couple of years, if not triple. And as I touched on earlier, I think workers in general will be more and more comfortable with receiving their pay in stablecoins, especially in emerging markets. And so, yeah, I think that's, at Dakota, that's where we think the world's going. So.
Yeah, I agree. I'm originally from Philippines, so I can feel the true value of stablecoins. And if in case some of you don't know, Philippines is one of the countries that has the highest remittance economy. So I definitely see stablecoins doubling at least, and and maybe even surpassing Visa in annual transaction volume.
All right, thank you, everyone.
Just checking if there are any questions from the audience that we might want to pick.
How much time do we have for the question?
We have time for a couple of questions.
I asked for time because the question is a bit complex, but my opinion is pretty interesting. I've been in crypto for 6+ years at this point, so I'm always for decentralization, and I'm a huge fan of that. But in matter of stablecoins, I see this decentralization and how much the liquidity gets fragmented as why Europe is losing on the stablecoin like shenanigans. Why Tether is winning on the dollar like TVL thing. There is no Minnesota USD, Texas USD or wherever. They just have one coin. I mean, Europe is Europe. We have euro, dollar, money is the most fungible thing, like by definition. 1 euro is 1 euro, $1 is $1. So that's why, like, on the dichotomy between if we are going to have a regulated stablecoin, like from Europe, from the main banks, etc., or if we're going to have the decentralized one, like 1 billion different decentralized from France, Berlin, wherever, like I think the regulated one are going to win. Just because at the end of the day, we were talking about...
Maybe go for the question.
Oh, yeah, sorry. I was going to ask that, but I think I prolonged too much. Like, do you really think that this decentralized way of doing stable coins are going to win on the hand? We are going to have 1 billion microeconomies like inside our European macroeconomy? Or Europe is going to say like, digital euro is our legal tender. Every other stable coin is just a step on top of it, and you need to swap it for the real euro.
Gotcha. You want to take it?
Well, it's probably more.
Yeah, it should work.
It's probably more a question for Paolo, but I would agree on the fact that, but this is Europe, right? You're absolutely right. There is no California dollar stablecoin and no Michigan stablecoin. There is just one US dollar stablecoin. Europe ticks different, unfortunately, and we will have many different, but ideally they all belong to the same MiCA regulation, so they are fungible. You can swap it, and what is left. And I don't even think that there is a liquidity crunch or a split in liquidity. Even if you have, in a maximum example, let's say 27 different euro stablecoins from 27 member states, at the end of the day, it's a risk management decision to say which one I trust. Do I trust a German regulator more than a Cyprus regulator? Do I trust a French regulator more than a Dutch regulator? Who sits in the cap table of the issuer? How is the reserve management done? We, for example, manage our entire reserves only in cash overnight. We do not invest in bonds. We do not invest in money market funds. We put everything in cash. We're giving up yield for the benefit of instant availability if somebody wants to redeem. Because it is simply against the idea of stablecoins. If somebody sends me stablecoins back, instant, on-chain, and then he has to wait, oh, sorry guys, I need to sell my bonds first, and it's Friday afternoon, you won't get your money before Monday. It's nonsense, yeah? So that's why it's our golden cow in the room. We do only put our money in reserve cash accounts, which are instantly terminated when somebody redeems the tokens. So I believe there will be plenty of euro stablecoins, but all falling under the same regime. They will be exchangeable, and the difference will be the risk factor of how is the reserve management done, and that every user needs to do himself.
Just sorry, quickly, I'll take it. Then Paolo, if you want to add something. I think in the US it's not that different. Like you also have Circle, that is the equivalent of what AllUnity is trying to do, and Tether, that is the equivalent of Frankencoin. If you want to, expand it. And so you also went to that process, but it's already kind of completed, and it went up to Trump, and they decided to take a direction. And it was easier because when you say, okay, we are going to open up this market, and they saw the opportunity to that we didn't see in Europe. We didn't thought like, okay, we can just print more debt and find new buyers of our debt using stablecoin as a weapon. In Europe, it was refused to take this approach. So that I think what makes the whole difference. And I also want to say that the biggest stablecoin was, again, invented by Italians, like banks. So I'm very happy. And Paolo, please go.
Yeah, maybe to explain, Frankencoin is more of equivalent to MakerDAO's DAI than to Tether. So it's fully decentralized. You don't have an identifiable issuer. And I think that is the use case of that is very much where the use case of crypto lies. So you don't have to rely on a counterparty to have their operations under control. If you want that, if your compliance department wants that and have someone they can call, then that's a great benefit. Some institutions really want that. But the crypto natives, they kind of want to get away from that. And that's why I think the decentralized stablecoins have an other audience to cater to.
In your case, it's more for a reservoir value. Like people get a Frankencoin to have like francs, but in the digital version, not to exchange franc to franc.
Yes, that is correct. Yes, it's basically store of value. Yeah.
Thank you very much to our panel, and we welcome our next guest.